Okay, this is Chapter 2, Part 2. I will be discussing taxes and coming up with cash flow. First thing, taxes. There's a difference between what we call the marginal tax rate versus the average tax rate. Okay, the marginal tax rate is the percent tax paid on the next dollar earned. So what happens is if you look at a tax table, it will tell you that, say, for example, up to $10,000, you will pay X amount of tax. And then from $10,000 to $20,000, you will pay, maybe it goes up to 12%. And then from 20 to 30, it goes up to 30%. That marginal tax rate is what you're paying for the additional dollar. Okay, an average tax rate is done just like an average. You're going to take the total taxes paid and divide it by the taxable income, and that's going to average out all those layers of taxes and give you an average tax rate. So the question is, if you're considering a project that will increase taxable income by $1 million, what tax rate should you use in your analysis? Well, think about it, okay? We're not going to be paying on that additional $1 million in income, taxable income. We're not going to be paying the average tax rate on it. We're going to be paying the marginal tax rate because we're adding that on top of what we've already earned. So the tax rate that should be used is the marginal tax rate. Okay, after the Tax Cut and Jobs Act was passed in 2017, the federal corporate tax rate in the United States was 21% for all corporations. This was a huge difference from what it was previously, and it in part helped spur the economy on in the last couple of years. Okay, let's go through an example of marginal versus average rates. Suppose you're single and your personal taxable income is $100,000. Okay, the question is, what is your tax bill? What is your average tax base? And what is your marginal? So let's go through and figure this out. Okay, so how do we calculate taxes on income of $100,000? Well, taxes are based on different levels. So for example, if you make $9,525 or less, you would be taxed at a 10% tax rate. So 10% of $9,525 is $952.50. Okay, once you hit $9,526, any income from $9,526 to $38,700 is going to put you in the next tax bracket of 12%. So we're going to take that $38,700, which is the top of the tax bracket, minus the $9,525, which is the bottom of the tax bracket. So $29,175 in income is going to be taxed at 12%. That's equal to $3,501. Okay, we're still nowhere near the $100,000 because we're now only at $38,700. So when we go from $38,700 to $82,500, that income is taxed at 22%. Okay, so the difference from $38,000 that was taxed at 12%, we're going to subtract that from the $82,500, or $43,800 is going to be taxed at 22%. So 22% times $43,800 is $9,636. Okay, from $82,500 up to the $100,000, the tax rate is 24%. So that difference between the two, $100,000 minus the $18,500 or $17,500, is taxed at 24%. So 24% times $17,500 is $4,200. If we add those four amounts together, they come to $18,289.50, and that is the tax rate that is going to be paid by an individual who the taxes that are going to be paid by an individual who makes $100,000. Okay, now if we want to find the average and the marginal tax rate, that's $18,289 on $100,000. The average tax rate, we're going to take the taxes paid of $18,289. We're going to divide it by the $100,000 in net income, and the average tax rate is 18.29%. Okay. So, and if you made one more dollar, you would pay 24 cents in tax. Okay, I'm going to go back here for a second. Okay, the tax rate is 24% or 24 cents on the dollar. Okay, so the marginal tax rate is 24%. Okay, the last main concept in this chapter is the concept of cash flow. Cash flow is one of the most important pieces of information that can be derived from the income statement. The accounting statement of cash flow does not provide the same information that we're interested in. So instead, what we're trying to do, our focus is how cash is generated from using assets and how it's paid for those who finance the asset purchase. Okay, think about the accounting equation. Assets equals liabilities plus equity. The liabilities and the equity are what finance the assets. So it's really important to understand from a cash flow standpoint how much cash is being generated for those people who finance the assets. Okay, so cash flow from assets. All right, it consists of three amounts. We're going to be picking up operating cash flows minus net capital spending minus changes in net working capital. Okay, and then there's another way to calculate it. You can take cash flow to creditors plus cash flow to stockholders, come up with cash flow from assets. Not quite as easy to get to, unfortunately, as the first method. So we're going to use the first method here. Okay, so an example of a U.S. corporation. The first number we're looking at is operating cash flow. And operating cash flow is going to be in earnings before interest and taxes, the 670. We have to add back depreciation because when we subtracted depreciation from from sales, depreciation isn't a cash number, okay? If you remember back from financial accounting, what we do is we buy an asset and then we depreciate it or take an estimated amount over the useful life of that asset and record that as an expense. The cash happens when we buy the asset, but the depreciation expense happens each year. So since we're trying to get a cash flow, we have to add that depreciation back since we subtracted it in calculating the income statement and it's not a cash item. We also have to, so we're going to add that back. So we're going to start with the earnings before interest and taxes. We're going to add back depreciation, and then we're going to subtract from that any taxes that we pay. So that turns out to be the 670 plus the 89 minus the 126, or 633,000. That's the operating cash flow. Okay, so that's the first number we need. That's this number right here. Okay, the next number is what am I looking at? This is the net cash flows from assets. So what we're going to do from fixed assets, we're going to take the ending fixed assets, which are 1709. We're going to subtract from that 1644, which is the beginning fixed assets. And so what that is that's the cash that we paid out. Since the amount of fixed assets went up, that's the cash that we paid out to buy new assets. All right, we had another, what is that, 956, so that's another $65,000 in assets that we bought during the year. We also have to add back the depreciation because the depreciation was deducted in calculating this net fixed assets. So we need to add that depreciation back in for the current year if we're looking at the change. So we're going to take that change, add it to what we bought during the period, and then that's going to give us $154,000 for the net change in fixed assets. Then the last, so that's this number here. So we're going to subtract that out, 154. We paid more, so it's a negative. If that number had been a negative number, ended up to be, it would have been a positive number here, but that's kind of uncommon to happen. Okay, the last number is the change in net working capital. Working capital, if you remember from financial accounting, is current assets minus current liabilities. So what we're going to do is we're going to find the change, we have to look at the beginning net working capital and look at the ending net working capital and subtract the beginning net working capital. The ending net working capital, total current assets are $1,403. Total current liabilities are $389, so we're going to take the $1,403 minus the $389. That'll give me the net working capital at the end of the period. We're going to subtract from that the net working capital at the beginning of the period, which is 1112 minus 428 to give us the beginning net working capital. Subtract those two, and it's going to give us a net working capital change of $330,000. I'm calling these thousands. I'm used to doing anything in thousands at least. Okay, so now to find the cash flow, what we're looking at is the OCF minus the NCF minus the change in the NCW. So we're going to pick up the 633 minus the 154 minus the 330, and our cash flow is $1,149. I'm sorry, not 1,000. Okay, to do it the other way, it depending on the situation, it can be easy to come up with or it can be difficult. In this one, what we're going to do is we're going to calculate the cash flows from the interest paid, and then the cash flows from for the shareholders, and then we can look at the total overall cash flow. Okay, so from a borrowing standpoint, the interest paid was 70, which we got right here. Our borrowing, if we look at the borrowing, this should not be. Something's goofy here, because this should be 454 minus 400. Oh, I'm sorry, that's correct. The 70 minus the 454 minus the 408, which is 46, and 70 minus 46 gives you the 24. That's how much cash went out for, came in, for debt. Now, if we look at the shareholders' equity side, 165 went out in dividends, minus the change in the common stock. They issued additional common stock of 40,000. So the dividends went out, the common stock went in. So that was a difference of 125,000. So the 24 plus the 125 is 149. Okay, so either method you can come up with a number. And this is table 2.4 for your textbook, which is basically all the formulas that we just used. Okay. It looks at the operating cash flow, the OCF, the net capital spending, the NCS, and the change in working capital. And the quick quiz, I'm going to let you take that on your own. This one goes through the Dole-Cola example, and I'm not going to go through this right now. I'm going to go through this in class on Tuesday so that we have a chance to go through and do an example together. This is not super easy stuff, and I do want to spend some time on a one-on-one with you. So we'll go through the Dole example in class on Tuesday. And that is the end of chapter 2.